Okay, so today we're going to be doing chapter 2, which is analyzing and recording our transactions. So this is definitely your debit and credit chapter. Right, so we're going to explain the steps in processing the transaction and the role of source documents. We're going to describe an account and its use in recording transactions. We are going to describe a ledger and a chart of accounts, and we're going to define debits and credits. Explain double entry accounting. Okay. So when we began last chapter, we talked about internal and external users. Now we're going to talk about external and internal transactions, right? So external transactions are transactions that occur between two different organizations, right? Let's say Starbucks has to purchase some vehicles for delivery. So they'll buy the vehicles from Ford. That's an external transaction. On the other hand, sometimes companies have internal transactions. Those are transactions within the company. Right? Some conglomerates, such as Disney, right? Disney's theme parks may want to use Marvel Comics characters in some of their themes or some of their rides. So they need to pay for the licensing to use those characters in their likeness. So they'll pay the theme parks, Disney theme parks will pay Marvel Entertainment to utilize those characters. Everyone with me? And because both of them are within the Disney family, that's an internal transaction. It's between two occurs within the organization. Everybody with me? Right. Good. Now we dealt with this another thing that we dealt with the last chapter, and this is sort of a review, right? Is analyzing recording information, right? So the first thing is we analyze the information. And what are we trying to find? If the information is what? Reliable. Not reliable. Relevant, which goes to another word.
Recent.
Huh?
Recent.
No.
Relevant.
No. If it's relevant, it's what?
Useful.
Starts with an M. Material. Fantastic. Material, right? To go back to what Diane said about reliable, right? We want to make sure that the information is reliable before we get it. That ties in with the ethics conversation, right? That the individuals that are creating the information are not only factual, but they appear to be factual, right? And then there are steps and processes we have to verify that this information is reliable. So before you even pick up the information, you want to make sure it's reliable. Otherwise, you wouldn't pick up the information from the beginning. That makes sense? Why do you use the news sources that you do instead of the majority of other news sources? It's because you trust them. You find they are reliable to give you the news that you need for your day. Everyone with me so far? So reliability, Diane is right, it goes in there, but that's something that is inherent. It's from the beginning of the information process. We are relying on the individuals and the entity that creates the information, and we trust them and that they're ethical. Right? So then when we get the information, the question is it material or not, right? Material information, we do what with it? We record it. Immaterial information, we do what with that? We file it. Fantastic. Everyone with me so far? Okay. So that's the recording process, and the next thing that we're going to do is post it to a journal. So we'll go over that today and making our trial balances. There's a step before we make those four financial statements that needs to be addressed. And we'll address that today. So going back here, source documents, right? Source documents are basically third-party documents that verify a transaction has occurred. They're third-party documents to verify a transaction has occurred. Now, some of you might be saying in your mind, well, if I'm the accountant, and the owner of the business comes and says, hey, we bought 5 trucks today, shouldn't we take his word for it? Not in accounting. In accounting, we have something called professional skepticism. I like to say we skepticize every day. And what do we think about it? Is this information true or not? So what lowers one's risk that the information is true? Source documents. Source documents from third-party organizations or individuals, right? Stuff like checks, bills, purchase orders, bank statements, sales tickets, right? You bought the trucks? Fine. Bring us the invoice. When we look at third-party documentation, we know, we pretty much assume that since the third party has no reason to lie to us, that they have no skin in the game, that is probably good information. Now trust me, auditors will come back and verify the documentation, a segment of it. Everybody with me so far? They're going to verify a segment of it. But we make sure that we get source documents. We don't go on just people's word for it. And why not?
Not only do people lie, but people are fallible.
Lying.
Sometimes people forget.
Oh, goodness. You really think your fellow man would lie to you?
Yes.
Oh.
Not you.
You would lie to your own mom.
Jesus
so
walk,
why not
baby.
somebody else?
Huh?
I said you would lie to your own mom, so why wouldn't you lie to somebody
You
else?
lie to your mama?
I was like 15. Who didn't lie to their parents?
I didn't stick my hand in the cookie jar.
See, unless you're talking, you just don't talk. That's not lying. You just didn't give the information. I'm just.
Unless remain silent.
Right. You're right.
Or you remain silent.
What is a business owner's motivation for being in that business?
Money?
To make profit.
Profit. Thank you. No more money. Say money. It's profit. Remember, they can make $5 billion in revenue, but if they got $10 billion in expenses, they are not. It's not successful. That make sense?
Yep.
They're there to make profit. Okay. So with their motivation being profit, can that motivation fly in opposition to the truth? Yes. So if the truth and the search to make profits, when they are in opposing ends, which one does the business owner choose?
Profits.
Profits. Not only do they have to choose that, not only do they choose it because it's their motivation, does that make sense? But they also choose it because it's the law. Legally bound to be profitable. If they were to do something unprofitable, it could set themselves up for legal liability. and it's supported by the Supreme Court. Everyone with me so far? So the profit motivation is very strong. I mean, it's just as strong as a pool for little kids, right? You put a kid at the pool, they're gonna swim, they'll swim and forget to eat. Because sometimes eating and swimming fall in opposition to each other. So you gotta make a choice. You're gonna eat or you're gonna swim. You're gonna ask my 10-year-old, you're gonna eat or you're gonna swim. They're like, swim all day. So, right, they'll starve. Go ahead.
But couldn't you also face charges for like lying on the books? Like,
Yes, you
so
can.
you could.
So there's where you have an accountant. Because the accountant's motivation is what? Tell the truth. Right? Be truthful about what is being prepared. Right? Because think about it like this. A business owner, oh my slide went down. A business owner can be found guilty of a fraud, but if they decide to create another business, they can, right? And once they serve their time and know what they've done. An accountant is accused or found guilty of fraud. Can they come back and practice accounting again? No. This will fly on the face of what? The ethics idea of appearing ethical. I've literally seen accountants, right? Some of the firms I've been with, they're very, very strict as far as their code of ethics. And most of them had an ethic code. I mean, most of them had a code such as if you had an affair on your wife, you were fired. Okay? Some of you think, what? Right? What's that got to do with, one's got to do with the other? You're there to work, you know, you just so happen to have an affair. No, because they see that as a show of your ethics. I literally had a colleague who had a 4.0 out of Indiana, graduated top of his class in accounting, was one of our top accountants, caught an affair. The next week he was a bricklayer. He was a bricklayer for the next 5 to 10 years. Don't fret, he was union, so he made pretty good money. He was a bricklayer. And he was top of his class in accounting. I've seen deputy directors go down for having their fling, and they go from deputy director to manager down at McDonald's. The appearance thing is serious in accounting. That's why most of the time you won't see accountants in Democratic or Republican squares, right? You know, picking a side or doing things that shows partiality. They want to seem impartial in all things. Everyone with me? Okay. So that ethics piece, although we spoke about it briefly, is serious. Now when it comes to business, because for accounting, ethics is the base of being reliable on your information. Right? So it's a big thing. Now for business owners, they're there for the profit motive. So profits come first. You don't necessarily have to be. You should. And there are things in place to make sure you are. But if we were really have a strong conversation about ethics in business, then I guess it would start with why do we have businesses that create things that kill people and incarcerate people and all these other things. That makes sense? Or why do they make business moves that make that things happen? So the profit motive is their biggest thing. And one of the ways we counterbalance that in accounting, right, when they tell us about transactions, is we need that source document to make sure they get it. There's no transaction that should be in the books without a source document. You don't have a document to point to validate that transaction, then that transaction is no different than the transactions that Mr. Rogers made in the land of make-believe when he took the little train down the street with the king and the queen. Go ahead.
Do you get receipts every time you go, like, buy anything?
You should.
You think so?
If not, then you should have some documentation to transact it.
I mean,
For
online
example,
banking.
like your card transactions. Well, and there was one time, like, I remember dealing with like construction companies, and they would go and hire guys just on the spot for cash. And they said, well, we don't have a receipt. Well, that's fine, but eventually the accountant is going to follow you and make sure you're hiring people. So there's going to be, and we'll talk about that in chapter 5. There'll be internal controls for those small things, but those types of transactions, they shouldn't be. Do you have a case in general? Right. So right, if there's specifics, but those should be very minute. We'll talk about like cash setup, internal controls of cash, and having a petty cash account, right? And so you have companies with petty cash accounts, but the majority of them should be getting a receipt. There are certain things that you might not have a receipt for, but that is so minute. That's so minute. And if you don't have a receipt for it, I trust me, any good accountant is going to follow you once or twice and look to make sure you're doing it. That makes sense. They're not just if you're spending, let's say, $1,000 a day on labor, that's a $30,000 expense a month. They're definitely going to come down there and see that you're hiring guys and what you're hiring them at. That makes sense? So, yeah, accountants can be investigators too. A little CSI going on there on the books. The account is an analysis or record of increases or decreases in specific assets, liabilities, equity, revenue, and expenses. Remember, we talked about assets, liabilities, equity, revenue, and expenses. We talked about that, right, for the last 2 or 3 days. Right? And then the general ledger is a record containing all those accounts used by the company. So what we're going to do with these accounts, we're going to see increases and decreases. We did that in those transactions at the end of chapter 1, right? We said we had cash. Cash was an asset. We spent cash on, let's say, supplies. So the cash decreased. That meant that the asset decreased. And second, we're going to pull in that debit and credit piece so that you'll know how to put the debit and credit to that increase or decrease. Here's the accounting equation. Let's do this one more time. You've got to know that something is very, very, very important when it's in the slides in more than one chapter. Everyone with me? So if you have not written this down, you need to make sure you have this down. We spent last class this is all we talked about. Assets are cash, accounts receivable, land, buildings, notes receivable, prepaid accounts, supplies, equipment. Go ahead.
Which one is long term? Is that accounts receivable or notes receivable?
Long term is notes receivable. Short term is accounts receivable. What's your name again?
Mine?
Yeah.
Maddox?
Yeah, Maddox. I don't know where I get. Maddox is bringing up a good point because right now I'm using something called a single step income statement and a unclassified balance sheet. When we classify this balance sheet, what Maddox is referencing, things being short term and long term, is going to be essential to what you're doing because we're going to break out the accounts into short-term and long-term on the balance sheet. But not right now, so don't worry about it. But in about a chapter or two, that is going to be how you're going to do your balance sheet for the rest of this course on into accounting 212 and any other accounting class you do, right? Same thing with your income statement. Right now, it's simple. It's just a single step. We put revenues on the top, expenses on the bottom, we get a net income. We're going to change that in the future. Just a precursor, right? So great question, Maddox. Liabilities. Liabilities are accounts payable, payables, notes payable, accrued liabilities, and unearned revenue. Unearned revenue we covered last class, along with the prepaids.
Wages payable.
Yeah, wages payable, right. Any payable. And then our equity accounts. Common stock, which is also capital N. Dividends, which is also capital out. Retained earnings, revenue, expenses. Mhm. Since we talked about the news, a little quick thing. Get your news from bland sources. I know that might be a little tough for some of you because you don't like the news. Some of you might be like, that's that stuff my parents made me listen to, and you're rebelling, what have you. But make sure you get it from bland sources because more than likely, they're telling the truth. Anytime you turn on the news, I'm just being honest. The set looks nice. The people look nice. If it goes past your mind, I think I would date them. Right?
They like ratings.
Right. Yeah. That's not good news. Right. Go over to PBS. That's what, I love like Fox, but man, does everybody look good and happy that day. Like, I'm up at 6 a.m., I'm pissed, and they're like, hi. I'm like, oh, snap. They're like your friend that smiles at you and it makes you smile. They're like, hi, how you doing? You're like, I'm fine. But I listen to PBS. I watch a lot of Bloomberg. I watch a lot of CNBC. Those are and CBS. I don't think any of them are under 50. Right? Never at any time did I say, ooh, I might would date them.
Well, I want to see the slide right before this one for a second.
Okay.
I forgot to write down the last thing.
Okay.
It was unearned revenue.
Yeah, I never think, man, she's looking great today. Add a turtleneck? But the facts that they give and the depth of the information is just wonderful. I tend to get my news from them. And then the other piece is just think, use your brain, read some books, you know, read a financial statement, go beyond just what you see. You're in academia now, you're a scholar, you're rising to the top of our society as far as intellectual thought. Be that. Don't just accept the average, conversation. I love it when my friends go, here comes Mr. Professor again with his stuff. I eat that stuff up. I'm gonna skip that chart because I want to show you just real quick. This is a ledger. Remember I was talking about accounts and ledger. So this is a ledger. This is what it looks. I just want to expose you to it. You don't have to write it down. I just want to expose you to it. Right? It'll look like this. Normally 100s are assets, 200s are liabilities, 300. I'm sorry. Yeah, 200 are liabilities, 300 are the equity, 400 are revenue, and then 600s are expenses. But they may change. This is normally an internal document, the chart of accounts. All right. Now I've exposed you to that. Let's get back to the accounts. This is what we call a T account. This T account is something that we use as a tool we use when we're doing debits and credits. When you see a T account, it'll look like this, right, with the account name on top. For example, cash. And then on the left side of that T account is a debit. On the right side is a credit. DB is abbreviation for debit. CR is abbreviation for credit. And so when you see a T account, you may see it look like this. And basically what you're seeing is there's a transaction where they debited $10,000 in cash. So you should see a corresponding credit transaction or a balancing transaction. And then at the end of the period, you'll see this, which is to signify the period is ended. And then you'll see a summation of the transactions prior to it. This will mean at the end of the period, they ended with $10,000 cash. Are you with me so far? What?
By period, you mean like a specified set time or like?
Specified set time, right? It could be quarterly, it could be monthly, it could be semi-annually, it could be yearly, what have you, but you'll see that. Now, debit, in the Latin, actually just means left. Credit, in Latin, means right. True story. So if you were to go back in time to Rome, ask for directions to the Parthenon, someone would say, the second horse on your debit, make a debit, go down 2 buildings, hang a credit. Your 3rd Street on your debit, look up, the Parthenon will be on your debit.
Are you being serious? No,
Yeah,
no.
I'm being serious. This is the truth. No, I'm being very serious. It's left and right. Right? Now, I'm saying that because I'm trying to keep it simple. Because a debit and a credit, depending on the account, has different effects on each account. Everyone with me? So I don't want you to get locked into a mentality that says debits mean up and credits mean down. Everyone with me? We mean different things for different accounts. So here we go. If you debit an asset, it reflects an increase in the asset. Time to write it down. If you credit an asset, it reflects a decrease in the asset. If you debit a liability, it reflects a decrease in the liability. If you credit a liability, it reflects an increase in the liability. Don't write down equity. I mean, you can, but remember, equity equals what? What does it equal, scholars? Capital in
Minus capital.
minus capital out, not plus expenses,
Plus revenue.
plus revenue, minus expenses. Fantastic. So we got a little ways to go.
Could you say that just one more time?
If you debit an asset, it reflects an increase in assets. If you credit an asset, it reflects a decrease in assets. If you debit a liability, it reflects a decrease in liabilities. If you credit a liability, it reflects an increase in liabilities. Go ahead,
So,
Alex.
If you increase the debit of common stock, that will be increasing the debit.
Wait,
It's like asset.
wait, we're gonna do common stock this time.
Okay.
So let's get to that question. If we debit common stock, we're reflecting a decrease in common stock. If we credit common stock, we're reflecting an increase in common stock. If we debit dividends, we're reflecting an increase in the dividends. If we credit dividends, we're reflecting a decrease in dividends. If we debit revenue, we are reflecting a decrease in revenue. If we credit revenue, we are reflecting an increase in revenue. If we debit expenses, we are reflecting an increase in expenses. If we credit expenses, we are reflecting a decrease in expenses. And while everybody's so diligently writing, I need a volunteer because I need to demonstrate something that's on this board or a problem. Somebody volunteer? Come on, leaders. One of y'all. Come on. Good. All these leaders, man, and nobody raising a hand. First time. What y'all think? It's a setup? It's like your dream, right? And that nightmare that you come up here and you're in your pajamas. You know. Don't worry. Accounting professors have a nightmare too. You know what it is? Is that one day I'm up here and debits are actually on the right and credits are on the left. And I've been teaching you all wrong all this time. All right. So, Robertson, right? Robertson's up here, and Robertson is an investor, and he wants to invest in a company. What's going to be the company? Put you on the spot.
Debits Unlimited.
What? A real company.
Oh, I don't know.
No,
real company, Apple.
Apple. Okay, all right. Like, is that really?
Oh, no, I thought you were making.
All right, so we're gonna invest. He's gonna invest in Apple. Okay, so we're gonna pretend that this is representative of capital, right? So we're giving him the capital. And I'm representing Apple, and he is the investor. So we're dealing with common stock here. In order for Robertson to invest in Apple, what does he have to do with that capital? He's got to give it to me, right? Everyone with me so far?
Yeah.
Robertson has to give me the capital in order for it to be common stock. Can I give him capital and that be represented as common stock as the company? No, right? The capital can only move one way in order for it to be common stock. Hence, you will rarely, if ever, probably never, use the debit. It's only for corrections. It's not actually for the initial transaction. That makes sense? Let's go to the dividend side. How does a company give a dividend to an investor? Scholars?
You hand it over to them.
Right. You gotta give Robertson the capital. Can Robertson give me capital and that be a dividend payment?
No.
No. It only can move one way. Everyone with me? So therefore, technically, there's no credit on the dividend side. Now you'll use it, right, for corrections, but not really for a transaction. Everyone with me so far? So if you look at these two, they're basically, you know, this equity section, they're basically, right, dividends on the debit and common stock over the credit. Everybody with me? So these two are basically one transaction. Thanks, Robert. Appreciate it. Everybody understand that? Now going forward, the revenue and expenses are the same way. If we debit revenue, we're reflecting a decrease in revenue. If we let's go back. If we credit revenue, we're reflecting an increase. If we debit expenses, we're reflecting an increase in expenses. If we credit expenses, we're reflecting a decrease. That technicality only runs for dividends and common stock. Everyone with me? Okay. So I showed you a T account for cash. This is another example of that. As you see here, we have 3 debit transactions and 6 credit transactions that affected the account. What do? They summarize the debit, they sum the credit, and the difference was a debit of $4,800. So with this company, on this date, well, whatever date this was, at the end of this period, I would expect them to have $4,800 cash in their balances. Everyone with me? So this is another show of T accounts. So where we are is here, right? And now we're going to do some journal entries. So let's start off. So the journal entry will look like this. Debits go first, credits go second. Credits are indented to the right of the debit. The date goes beside the transaction. We have the transaction date, the titles of what you're doing, of the accounts you're increasing or decreasing, and the amounts. Notice there's no dollar sign. Why not? What's the assumption?
Monetary net.
Monetary assumption. There we go. Good. And that fourth one, that's just a note. So going to talk about, let's go into some transactions. So let's do some transactions. Here we have a shareholder invested $30,000 in Fast Forward. So let me go back to those questions that I asked you at the end of class, the last class, right? So question number 1, is it cash or credit?
Cash.
Cash. It's a cash transaction. So my second question is, what did we use the cash, or if it was credit, for? What did we use it for? To invest. And investing is what? Common stock, right? So 3 is, what account is it? So common stock is what type of account?
Equity.
Equity.